You can give the usual mantra, maintain a reasonable monetary policy, accommodate shocks where you can, etc. But these are actually order moving or global moving changes. And I think we need to anticipate that we'll have to react to these also.
Meanwhile, if you want to add to the soup of uncertainty, this past week there was a real challenge to the idea of central bank independence, in particular, to whether this president could fire Fed Chair Jay Powell. There seems to be a walking back of that. But Governor Remolona, I'm wondering from your perspective why it is so important to have central bank independence and the difficulty that comes into play when that is called into question.
Well, let me say first that we're fortunate in the Philippines to have had central bank independence for the last 30 years. That means that the national government doesn't ask us for money, and that's very important. That means we can control inflation, and then we don't have to worry about hyperinflation, which is what tends to happen when the central bank loses independence. So we're very fortunate in that regard, but independence is crucial, I think, for the central bank to do its job properly.
Governor Kganyago, I'm wondering from your perspective, the importance of that and the importance of flexibility, of being able to respond in a way that doesn't only have to do with interest rates, but also has to do with a currency that's free floating, that also has to do with some other attributes that South Africa has adopted that is more free markets rather than centrally controlled.
You know, we had a particular experience with the currency. There was a time that the central bank believed that it knew more than the market about what the level of the currency should be. $26 billion later, we came out losers. And we had to change our framework. And we decided to adopt a policy framework that is the inflation targeting framework. And then, of course, if you have an inflation targeting framework in an environment where you have a central bank that is constitutionally independent, it becomes an easier thing to navigate. And Raghu talked about the nature of shocks that you would go through. And we've been able to navigate the shocks coming through. And I think that the issue, people sometimes talk about the issue of central bank independence almost in isolation. But the thing about central bank independence is that it talks to institutions in society. And so society creates particular institutions to deal with particular mandates or deal with particular problems, and then sets the parameters against which such institutions would operate. And so central banks have been created in society with particular mandates. In our case, we have got a price stability mandate, and that is what we pursue. But independence is also earned. You can't just legislate it. The conduct of the central bank should be such that it stays true to its mandate, true to the remit society gives it, so that it does not invite unnecessary attacks. And the academic literature is actually fairly clear that central banks that are independent had actually served society better and have depicted better monetary discipline than those that have not been. And the trend globally had been a move towards more central banks being independent than central banks being less independent.
Dr. Gopinath, I'm wondering from your perspective, and I'm going to put you on the spot, if you see some central bankers concerned that if the world's first and foremost central banker, Fed Chair Jay Powell, could come under threat, that opens the door to their independence being threatened more significantly.
I mean, I'll just double down on what Lesetja said, which is it's not just academic research, even research at the IMF shows very strongly that central bank independence has been very beneficial for macro stability and financial stability in economies. And indeed, more and more countries have moved towards that for the reason that it delivers these big benefits. One of the issues I do want to raise, and I know that Lesetja deals with it in South Africa, is if you look ahead and you think you're going to be in this world, which is unpredictable and shock-prone with a lot of different things happening, I think emerging markets central bankers are going to also have to pay attention to what's happening with capital flows coming in and out of their economies. And some things have changed there. So this is not a new issue. Central banks have always had to deal with it. But another development is if you look at the share of external financing that emerging markets depend on, that comes from non-bank financial institutions, including pension funds, investment funds, and hedge funds, that has grown to about 40%. That's the number right now. And what that means is that those kinds of capital flows are very sensitive to the global financial cycle. And they generate a lot of volatility and can create problems with monetary policy transmission in your economy, including through the impact on the exchange rate, right? So I'd love to hear Lesetja's view, because I know he deals with these issues in terms of how do emerging market central bankers deal with these new kinds of volatility that they have to face with. The other second point that I will make is, I mean, kudos to emerging markets. They've actually demonstrated a lot of resilience after some pretty tough knocks, including the pandemic, including the energy crisis that we saw. And if we have to take a lesson away from it, the reason that they had that resilience was they built up good, solid monetary policy frameworks. The inflation targeting regime, maintaining that credibility and the commitment to it in an uncertain environment will firstly require also proper communication, which I think can become a challenge in this environment. I'm curious to know how Raghu thinks about this. How do you communicate as a central banker in an emerging market? Because on one hand, you're still in the process, several are still in the process of building credibility, and talking too much can create a lot of confusion and not really help. But on the other hand, when you're in this environment when there's so much uncertainty, how do you convey that you are sticking to your mandate and you are sticking to the goals of monetary policy? So focusing on sound communication, on committing to inflation targeting, on anchoring long-term inflation expectations, that's going to be very critical. And I'd love to hear some responses to some of the questions I asked.
Well, just on the independence, I think no set of laws can protect a central bank when society turns against it. I think this is Lesetja's point. Your independence comes from the constituencies who believe you perform a vital function. And it need not be the head of state, but it can be bond market players, it can be banks, it can be the broader public, which likes a regime of low inflation, and you've convinced them that you're central to that aspect. So I think to Gita's last point, part of your communication is to indicate that this is an important function. And you're trying to go beyond the set of analysts who follow you very carefully to the broader public and say, look, we are providing a function which is important. There is a reason we just don't reduce interest rates, because it can affect you in so many ways through the currency, through longer-term inflation, et cetera. That communication has to be handled very carefully, because if you communicate too much, it's not just you confuse. Politicians get angry. Why are you interacting with their constituency? You're unelected. How come you can do this? If you communicate too little, you haven't built up the support, which you absolutely need against the forces who want to go in the other direction.
But to build on what Gita is talking about, there is this feeling that maybe there needs to be more of a scenario analysis approach rather than just saying, you know, this is our target, this is what we're heading toward. I mean, I guess that, Governor Kganyago, from your perspective, do you see that kind of approach, that there needs to be more scenario analysis, there needs to be more of an intellectual explanation for what goes behind the calculus?
I think that Raghu built an important point here about the communication. For me, there are two things here. One is to communicate what the role of the central bank is. What is the mandate of the central bank? And the other is communicating what happens if you cannot meet the expectations of society. How do you explain yourself to society about why you have not been able to meet their expectations? And that are two important pillars of communication. But I think that central bankers also need to understand that talking to themselves is not going to win the credibility in society. And we spend a lot of time talking to ourselves and talking to the people who understand what we are talking about, the professional classes. And the best defense for us is actually our ability to communicate with society. And that means that you have got to be able to layer the communication without confusing the message. You are still communicating the same message, but you have got to be targeting the people differently. So Raghu says that the politicians feel that why are you talking to your to our constituency? Is, you know, getting out there and communicating with the public. For the politicians, when you look at it, it's tantamount to you swimming with crocodiles, because that is where they play. And so if you're swimming with crocodiles, the swimming becomes challenging, because now you've got to be navigating those dangerous waters. And lastly, on the point you have raised about the scenarios, is that Gita points out this thing. It's very, very, it's not just difficult to make policy, because for us to make policy, we have got to have data. We have got to have an idea of what the future is going to look like, which means that you have got to put forecasts. And forecasting in this environment where there are so many moving parts becomes a challenge, and hence the issue of the scenarios. And the scenarios, they are useful. The professional class understand what you're doing, but the public do not see it that way. They might actually be seeing it as another forecast. And they are useful, the scenarios, they help us communicate with the professional class, but they become a bit of a challenge when it comes to the public, for the public to understand what does that even mean, that this is a scenario, whether you call it an alternative scenario and so forth. And to give you the example, so we had to communicate this thing, and we released and we said that this will be the impact of the US tariffs on the South African economy. And the headline that went out was, Central Bank warns the politicians. That was the headline that went out. So communicating this, you've got to be striking the balance, but you've got to understand you are communicating to audiences with different levels of expertise.
Governor Remolona, do you want to weigh in on swimming with crocodiles?
Oh, absolutely. I would say one way we communicate is to have an inflation targeting framework. We tell the public the inflation rate we want. If we're away from there, we tell the public how we plan to get there. And if we're there, how we will keep ourselves close to the target. That's an important part of communication. And communication, I think, is very important for credibility. To be credible, we have to achieve what we say we're going to achieve. And we have to be transparent. We have to explain what we're doing in terms that the people and the market can understand. It's absolutely, absolutely important.
And there's always this juggle between how much to swim with crocodiles and how much to speak amongst yourselves. There is this question about which tools to use, and whether there are some tools that are becoming in central bankers' toolkits that are becoming more I want to say fraught, simply because of their frequent use. And Dr. Rajan, I'd love to start with you. This idea of controlling capital flows, the idea of foreign exchange intervention, the idea of tools that have been used for a long time. Does it become riskier to use them in a moment like this with a lot of shocks, or does it become necessary?
Look, I think when you look at it from the perspective of emerging markets, the movement in foreign exchange rates are much more sensitive to shocks than in industrial countries. And those movements can have feedback effects. In India, for example, everybody watches the dollar-rupee rate. Not the real effective exchange rate or the nominal, it's the dollar-rupee rate. A lot of middle-class parents have their kids in the US. That affects the funding of those things. It becomes a very central sort of number. And so if that starts collapsing, questions are raised in Parliament. Why is the rupee depreciating so much against the dollar? And it becomes a source potentially of some kinds of panic. So broadly speaking, I think the Reserve Bank has focused on reducing volatility in that rate without saying this is the level. That's very dangerous. You don't want to defend any level. But you want to reduce the speed of reaction to anything. And in that process, you may build up reserves, you may sell reserves. It's not unidirectional. And the way you explain it to the global audience is we're not targeting rate. We don't use this as a comparative tool. This is more a precautionary tool to reduce the volatility, but also in the process sometimes to build up reserves so that we can have a way to reduce that fluctuation. Higher reserves also build more confidence that you have the capacity to intervene if necessary. What is important is, of course, to be judicious in that intervention. And, some of us fail, some of us succeed in that. But I think broadly it's a tool you don't want to let go. You do want to use it.
Governor Kganyago, you were nodding when you said that you want to mitigate some of the huge swings.
Yes, I agree with Raghu, and again, it brings the issue of communication once again. When you do it, at some stage, there will be an indicator that shows. So if you had been in the market buying foreign exchange to smooth the volatility of the exchange rate, at some stage you will report that the reserves are up, right? And the question will come, why did you buy additional reserves? And so you've got to be ready to communicate it. And it can also go the other way if you had had to intervene by selling foreign exchange rather than buying foreign exchange. And of course, there is this thing that you have got in that communication becomes important, because for some reason, either the public or the politicians think of the exchange rate as like the share price of a country, and you've got to get that out of the way to say that that is not how you should actually be that is how you should be seeing it. But that brings us to another very important question, because one of the things that had recently come had been central banks making losses, and in the main had been in the advanced economies. Many emerging market central banks had made massive profits. What had been the source of those profits? It had been from the depreciation of their currencies, and thus made foreign exchange gains from those reserves. And it starts a different conversation in society about the use of those resources, another big communication challenge.
Dr. Gopinath, I'll come to you in 1 second on the big picture, but before I do that, I do want to ask Governor Remolona, there's a different tool that's been used more in Asia than in other emerging markets, which is the capital flows management. It hasn't been used as much in outside of that region, and I just wonder why you think that is, why it is a more controversial method to either prevent flows from leaving a country or to somehow adjust things to improve that, but increase that. How are you thinking about that going forward?
Before I answer that question, let me add to what Raghu and Lesetja said. if you look at inflation around the world, the single biggest risk factor that distinguishes emerging markets from advanced economies is the exchange rate. It's the exchange rate. What happens in the Philippines is the peso swings up and then it swings down. It appreciates and depreciates, and usually it's a dollar story. It's a dollar responding to geopolitical factors. It's mostly a dollar story that raises the value of the peso, reduces the value of the peso. The parts of that swing, which takes over 3 to 6 months, in which the peso depreciates, that's inflationary. That causes inflation in the Philippines. When the peso appreciates, there's no effect on inflation. So it's a one-sided thing. So what we try to do is dampen those swings. So this goes to your question about exchange rate management. We don't like to do capital flow management. We stay away from that, and we'll continue to stay away from that. But we do intervene in the markets. It's not to intervene to reduce the day-to-day volatility. We don't do that. We intervene when we see that the peso is swinging to a point where it becomes inflationary, and then we try to slow down that trend. That's what we do. If you look at the experience of inflation targeting, there's a compelling reason to do that. You're using foreign exchange intervention for purposes of managing inflation, and that's okay. That's perfectly okay.
Dr. Gopinath, how much are you seeing the idea of a shock-prone world being a more appropriate one to dampen some of this volatility? Because as Governor Remolona was just saying, inflation tends to stay up, or prices stay up. They don't go down once the shock has subsided. Is it more appropriate or less appropriate at a time like this?
So, given the world that we're in, and given the numerous shocks that we have faced, and while we can all hope for a more predictable, less shock-prone world, I think it's a good idea to firm up your policy frameworks and your toolkits for a much more volatile world. For an emerging market central banker, they are grappling with much more difficult trade-offs than a typical advanced economy central banker has to deal with. And the exchange rate is a variable that is pretty unique to the kinds of challenges that central banks have to face with. So it's, you're concerned about whether you can get your price stability mandate working and your financial stability going at the same time as your exchange rate is depreciating, and how do you manage those trade-offs? I think what we have learned from the last few years, from the vast experience of the many emerging markets that we work with, one, it helps absolutely if you have a very clear monetary policy framework, and if you rely on your policy rate as the main tool for doing monetary policy. I think that remains the case. So while you do have these additional tools in your toolbox, you don't want to keep using it multiple times because it can be terribly confusing. So the policy rate remains the main tool for doing monetary policy. Now, there are going to be times when you want to use other kinds of instruments. And then being able to explain exactly why you are using something else is going to be very important so that you minimize confusion. And here I'd like to mention that at the IMF, we've done work on the integrated policy framework that has precisely helped central banks communicate better also in terms of when to do these interventions. So if you're intervening because there are disorderly market conditions and because of financial stability concerns that may be building up, then you explain that's why you're doing it for. You're not doing it because you're targeting a particular level of the exchange rate. Volatility in and of itself is not a problem unless you see it showing up in indicators of financial instability or market dysfunction. Because then you point to that and you can say, well, that's the reason I'm in the market right now, otherwise I don't do it. So that gives you clarity on how this works. And then the last point is, again, an issue that emerging markets deal with, and maybe advanced economies are going to have to worry about it more, is the kind of the overhang or the shadow of fiscal policy on monetary policy making, right? Which is, very often the reason a country's currency is depreciating is because fiscal policy is not in line with where it should be. Or the reason that you're seeing risk premia go up on their bonds is because fiscal policy is out of line with good policy making. And while maybe central bank governors can't say that directly, I think as the IMF we can say this, which is it's absolutely critical and important in this period of volatility for fiscal policy to be supportive and doing the right thing to be able to stabilize the economy, as opposed to just having unsustainable buildup of debt, all of which central bankers can't deal with.
Dr. Rajan, it leads to another question about another tool that is in the toolbox, which is asset purchases. And given the fiscal challenges, some of the challenges from the central banking side of things, for using that tool to suppress some of the volatility.
Well, I think that's a place which is a little less, it's less clear, it's helpful, and I think it's more dangerous to assume that we can affect asset prices. I presume you're talking more than just bonds, but even bonds. There's a real question about whether you're confusing markets, and what you manage to make go up now may eventually have to adjust. And is that going to create more volatility down the line? I mean, clearly, we've had a lot of quantitative easing across the industrial world. It was perhaps not as confusing when these countries didn't have a fiscal problem. And you could argue this is based on market functioning, and maybe it has a monetary function also, though being clear about which one you were really doing was also very important, and I don't think central banks have been that clear sometimes. But what we're seeing increasingly is, there's a fiscal issue in a number of countries. And for central banks to be supporting the sovereign debt at that point looks a lot like what we got away from in emerging markets, which is fiscal financing by the central bank. So I think you have to be very careful on that. You have to be even more careful when it's non-sovereign assets, when it comes to stocks and so on. I think then you really look like you're affecting market levels, and that could create a lot of uncertainty in markets. When are you going to come in? When are you going to leave? So I would say, by and large, let that be the realm of markets. And going back to the policy, use your interest rate tool as best as you can, and recognize if you are ever in a situation where you're at the zero lower bound, we've seen that these other tools, asset purchases, have modest effect. But more important, they create a problem for you down the line. How do we get out of this? How do we sell the assets on our balance sheet because the markets haven't gotten used to it? This is a huge issue for the Fed, which the central bank balance sheet being so big, reserves out there being so big. How do we get back to the old central bank balance sheet size? Probably not possible within the foreseeable future.
Governor Kganyago and Governor Remolona, you both were nodding, so we'll start with you. Governor Kganyago, do you have anything to add?
I agree mostly with Raghu. Of course, when we were hit by the pandemic, the economies around the world became unnecessarily weak. And so in that situation, interest rates were already very low. They were at what we call the zero lower bound. You had no choice. You had to do some massive asset purchases. And most central banks around the world did exactly that. The thing is, when the crisis is over, when the pandemic is over, you have to remember to buy those assets back. To sell those assets back. You have to remember to sell those assets back so that you go back to normal. Otherwise, they cause all sorts of distortions. But it's a tool you can use sparingly.
Governor Kganyago?
No, Raghu is right. When the central bank gets into the bond market, it's almost something that you have got to explain in a similar way when the central bank gets into the foreign exchange market. What is the policy intent? Why are you getting in there? And we did asset purchases in the middle of the COVID, and we said there was a market dysfunction, and And it becomes an interesting thing even describing the market dysfunction, but basically we had a situation where prices were no longer being quoted, and that is why we came in. And it was very clear that we will come in at our own terms when we have to, but then treasuries got addicted to the fact that there is a buyer who always comes in and they take their guts off. And when the central bank has to be stepping back, it's almost like, why are you stepping back? Well, there was a shock, there was a concern. Well, there is a crisis right now, you should be into the market. And so, at that stage, that is when central bank independence becomes very valuable, because then the central bank can just step out on its own. You could imagine then, if you didn't have central bank independence, then the central banks would have been in buying forever.
Dr. Gopinath, I'll give you the final word because we are running out of time. But I want to get a sense, just to sort of sum up in this sort of shock-prone world that you see us and have identified us as being in, what you see as the biggest challenges, the idea of maintaining independence, of being clear with communication, of communicating enough but not too much with the crocodiles. How you see this going forward?
Right. Firstly, I think we should recognize that many emerging market central banks have gotten really good at this and have been doing a great job in delivering stability to their economies. And so continuing on that path, which is strengthening your framework, strengthening the credibility of your framework, which is critical, and which is why central bank independence is critical, to have that, to continue building that credibility. Because when you are in an incredibly uncertain time, you can be sure that you are going to get some things wrong. But it has to be viewed that you got it wrong because of general economic uncertainty, not because this was politically motivated in one way or another. So continue to build that credibility is absolutely critical. And when it comes to FX intervention, and I'm going to stop with that, which is, again, when you're in very uncertain times, and given what we're seeing right now, which at this moment is not, I would not describe it as disorderly market conditions for most countries. Of course, for some they may be, but for most they're not. So I would say keep your powder dry, because when you're going to have more volatility, that may show up in the future. But at this point, it's prudent to keep your powder dry.
I just want to say thank you. That was really tremendous. And it, to me, is a really important discussion to be having in a newly shock-prone world, to quote Dr. Gopinath. Thank you so much for being here.